Okay, now this is the third discussion on the SL3 July 2021 paper, and I am moving to the question 3, which is in the section 2 based on the common precedent. Now Lamai, these 50 marks question, the 30 marks for the calculation, one of the huge or maximum marks allocated question in your paper, and entirely 30 marks for the calculation, which cover in your the resident company taxation, the entire part, the 30 marks it is there, and samely 30 marks awarded for you all. Okay. Now before the examination precedent issued, then this is for that time, the July 2021 examination, it is educational industry, then based on that the entire unseen question has designed. Okay. Come to the section 2 question 3, this is based on precedent. What is the part A? Part A, computation of balance tax payable by resident company for year of assessment 2021. And Lamai, when computing the balance tax payable for the year of assessment 2021, I have made some changes after the amendments. Then for this time your examination testing with the amendments reference to the Inland Revenue Act, the amended Act number 10 of 2021, then the tax rates, and I have the allocated the profit among the particular the tax rates which we need to take. Likewise, some changes were made. Then first I need to communicate it now. Then based on that the answer, there are differences. Okay. Then this for 30 marks entire calculation, and I am thinking that you all have an understanding about the changes with the new changes. I have mentioned the supplementary has issued on the study text, then please go through the main study text and the supplementary and all other the relevant gazette notification and all these things you should study well. Second, which is part B, advice on tax implications or benefit of business decision with transfer pricing issues, the Roman 1 and 2. I will come to this 10 marks later, and again is tested for the tax planning and business tax planning part, plus it is a business decision has taken by the board of directors, and that you need to tell whether this is under tax the evasion or a tax avoidance scheme, and you need to evaluate the transfer pricing issues totally with the tax planning and advising part. Then income tax administration, the 10 marks, it's income tax and VAT both, the assessment procedures are the tested, and it's for the 10 marks. This is the amalgamation of the 50 marks. Then I am quickly go for the computation part. Before that, Lamai, let me analyze the precedent a little bit for you to have the overall understanding. Come to this precedent, the company overview, just to at least know the company name and what's the industry, what is the segments they are engaging in. Look at this. Name of the company, College of Business Education Private Limited. College of Business Education Private Limited, CBE. Nature or principal business activities, which is providing of educational services. Now the income tax rate for the providing of educational services as for the first schedule with effective from 1st January 2020, it is 14%. Only for that gains and profit of the providing of educational services. Then sector, we are in the service sector, and and then date of incorporation has not provided. Co-founder is there, Mr. Manilal de Soisa. Locations of CBE, which is College of Business Education, head office in Colombo, and the 7 branches outside the Colombo. Products, portfolio and percentage of revenue. Undergraduate education 20%, postgraduate education 30%, professional or executive education 35%, short courses 15%. This is the product portfolio in that, and this is the shareholding structure. The number of shares, it is the 6,250,000 at it is the 40% with Lalit Kiryalla and the rest with the other three the shareholders. Value of shares is given in the financial position 625,000. These are the key information about the company CBE. This is the overview. Now if I need we will see the common pre-scene also. Now the your one also issued. This is the last time common pre-scene for June 2021. The College of Business Education. This is the information provided. Everything done now. As usual, what I am doing while reading the question, I am going to the adjustments and doing the adjustment in the same manner. Okay. Question 3 based on the common pre-scene. In addition to the information provided in the common pre-scene in relation to the College of Business Education Private Limited CBE, you are provided with the following additional information for the what's your year of assessment, year ended 31st March 2021. Income statement of CBE for the year ended 31st March 2021. Revenue, there is a note. See Lamai, the value is in the billions. Not in 1,000 rupee terms, it's in the billion. The direct expenses are there, then gross profit. Administrative expenses, there is a note. Other income, there is a note. Profit from operations and finance income 61 million. You need to go for a note. Finance expense, there is a note, and profit before income tax, which is your starting figure of your calculation, 552 million. Then revenue. This is the analysis of the revenue is really important. Now please understand Lamai, the 14% of the income tax rate is applicable for the gains and profit from educational providing of educational services only. If there are other income, it should be taxed at the different tax rate because the no separate accounts provided. Therefore, when calculation is doing, I will explain. I have taken is under the revenue proposition. Then course fee is from the 1 billion, it's from the educational services. Hostel fee, it's not the educational services. Library fee, educational. Registration and renewal fee, it's educational. Resident fee, educational. The hostel fee is not the part of the educational fee. It is not hostel fee, is not receiving the due to providing educational services. It's not receiving due to providing of educational services. Then it's a providing of accommodation to the students. If the student can stay in the hostels, or students can go for their own the boarding places while they are conducting their degree programs. Therefore, my hostel fee is not from the providing of educational services. It is for the providing of accommodation services to the students. Okay. Then if the information provided, you can go, this is effectively connected to the business likewise, but in my terms I have taken this other than the educational services. Come to next one. Extract of some of the expenses and outgoings recorded under direct expenses and administrative expenses. Remuneration, academic and non-academic. Royalty to partner universities, not yet paid. Training and development expenses, 15,271,500. Compensation, 2.4 million. Promotion and marketing, provision for employee retirement gratuity disallowed. Research and development expenses we need to look at. Bad debt write-off we need to look at. The contractual services we don't know. Maintenance and utility charges, depreciation and amortization disallow. Provision for slow moving stock should disallow. CSR expenses should disallow. Consultant fee paid for academic appeals, we need to look at what's this expense. There are other income from conducting carnivals and fairs, profit from sale of books and publications, second one, then grant received from the district secretariat offer for the proposed expansion project, 900,000, writing back of registration fees registered and advanced. These are the other income provided. More or less these are effectively connected to the business of the providing of educational services. All are with relevant to the this CB, relevant to their main business operations. Okay, CBE. Forgot the name suddenly. Then finance income, interest income from term deposits, gross interest income from the special event fund, interest income from the lectures loan, unrealized gain from unit trust investment. Since it is unrealized, we cannot tax it. Realized exchange gain from the referral fees received, because the referral fees, if it is effectively connected to the business or not, we need to look at, and we need to take this under business income or not. Lamai, since we are in this finance income part, I need to tell previously, that's mean prior to 1st January 2020, you all had the withholding tax provisions. Compulsorily now you don't have the withholding tax provisions. If the taxpayer has given the concern to the particular financial institutions or a withholding agent to deduct the advance, the income tax AIT only, this AIT tax credit is coming, then please keep these things are in mind. Now there is advance income tax, no withholding tax provisions are there. Then therefore this paper, any withholding tax deductions I am not considering, because for your examination these are not applicable. Then but applicable is advance income tax. Finance expense, bank overdraft interest and the bank charges are there. Now as usual, I am starting from the adjustments, the Roman 2. Before that I am going to the Excel, and this is schedule 1, computation of assessable income from business, CBE Private Limited, the TIN number with the 9 digits, schedules to tax computation for the year of assessment 2021. Then this is computation of assessable income from business. It is I am going with the plus minus formula, going with the plus minus formula, and starting from the accounting profit before tax, there is a accounting profit before tax of 552,067,705. Okay, this is the profit before tax that amount has considered. Now I am directly coming to the one by one adjustment. CBE has agreed to the providing terms and conditions per contract agreement and MOU signed with the respective partner universities for the usage of study text materials of foreign universities. CBE will remit royalty to those partner universities at an agreed basis. When students follow foreign degrees as a result of reference made by CBE, the referral fee will be paid to the partner universities of CBC at the agreed basis. What this has given for tell the relationship between the foreign universities. Why this important to us? Because there is see in the administration expenses we are having royalty to partner universities not yet paid. It has the given inside this payment is for this one. CBE has agreed to the following terms and conditions as per the contract agreements and MOUs signed with the respective partner universities. We have already signed the contracts. According to that contracts, this expenditure for this year of assessment 2021 we shall incur even it has not paid. For the usage of study tax materials in foreign universities, CBE will remit the royalty to those partner universities. Is it the expenditure incurred for the production of income? Yes. It's very clearly given for the using of the study materials. Then we will come to the adjustment lamai. It is talking about this one, royalty to partner universities. Then here we go, royalty to partner universities. This is allowable under section 11. Lamai not yet paid, you cannot consider. If the expenditure is relevant to the particular financial year, then if it is a paid or not, it doesn't matter. If it is incurred, that means it is attributable to the year of assessment which we are talking about. The agreements were signed. According to that agreement, you have to pay that amount definitely. Then it is a relevant value applicable to the year of assessment. Then therefore, it is incurred for the providing of educational services to the student. Then in the section 11 main deduction rule, it is an allowable deduction. Done. Then the next adjustment, royalty we have done, and the next one, there is a reference fee they are receiving in terms of the revenue in the breakup of revenue, if not mistaken. Here, yeah, we will see this talking about the reference fee when a student follow foreign degree as a result of referring the references made by CBE. A referral fee will be paid by the partner universities to CBE as an agreed basis. This is our income when it is received, it is our income. Then third one, course fees recorded under revenue includes the following. Course fee, the 1 billion of course fee is there, course fee 1,085,000. Then here facilities fee, facility fee received from letting out the college premises to private class teachers, rupees 195,000. Vacant lecture halls and infrastructure facilities in branches have been used by private class teachers over the past few years. Then per the agreement, CBE is entered in to receive 25% of the tuition fees collected by the private class teachers as the facility fee. Then Lamai, this is what, this is, you need, why this has given. You need to take a code, is this effectively connected to the business or not. Now we need to analyze this. What are the halls given for the tuition providers? It has given the branches and their head office, any vacant buildings. That means buildings which already suited to provide the educational services, but in this time these are vacant. Therefore, the particular buildings given for the tuition. Which building given? Buildings available to provide educational services. Then this is effectively connected to the business. This is not the other income. Then second one, referral fee. This is the fee which I have looked for. Referral fees received during the year from foreign partner universities, rupees 5 million, is part of the educational income. Then we will come to that. Here, facility fee received from letting premises to private class teachers. This is effectively connected to the business. Therefore, no adjustment required. I have explained it. Secondly, referral fees from partner universities, that also effectively connected to the business. The partner in agreement signed, and it's the way of the referring the students to the educational services. Done. Then the next one, fifth adjustment, training and development expenses include rupees 5.6 million incurred by CBE on the master's degree program followed by some of its academic staff in a foreign faculty. Now what happened? the 5.6, the training and development, it has the master degree programs conducted by the academic staff. Then 5.6 million, it's included in the training and development. Lama, you need to look at some requirements here. Here in 15 million, 5.6 million is there. You need to look at first thing, if the staff has done the academic degree program, whether it's related to, if they are the lecturers, if these expenses related to the production of income in future, or production of income in a current year of assessment. That's the first thing. And second thing, is this degree program, this cost incurred by the CBE, is it considered under the employment income of this each individuals? We don't know. And finally, if not, this is what? Domestic expenditure. Come to the explanation. It has given the training and development of master's degree in foreign faculty. It is disallowed. The main thing for the disallowable is we don't know whether it has considered under employment income of these each individuals. Then it is disallowed 5.6 million, and this is the academic degrees. Then it's whether it's effective incurred for the production of income or not, we don't know. After having a degree, then next week if they leave the company, we don't know, then this should be disallowed. This is not the expenditure incurred for the production of income, and in kind of these are domestic expenses. Done. Then the next one, the next adjustment, the total research and development expenses has been incurred on a scientific research carried by CBE with the collaboration of a private company. Under section 15, the research and development deduction, if the section 11 main deduction rule, main deduction criteria satisfied, then even it is a capital nature, we can deduct the research and development expenditure. If there are three criteria, it's a scientific, industrial researchers, and the high value of agricultural products, and then improving the business process or products. Now this has given for a scientific research carried by CBE with the another institute, collaboration of the private company. This is an allowable deduction, and there is the double deduction requirement under the 6th schedule under temporary concession. Lamai, earlier, that means prior to this amendment, it's only for the 3 years of assessment with the commencement of the act, but now it's the 5 years of assessment. It has extended to another 2 years. Now it's the 5 years of assessment under the temporary concession. The double deduction is available, or additional 100% deduction is available. Come to this adjustment, the research and development expenses incurred on scientific research, 100% additional deduction under 6th schedule. Now in the income statement, if you can see under income statement here, the research and development 3.710 already deducted. Then under the 6th schedule under temporary concessions, we can take another same amount, 3,710,000. Now we have done it. Done. Then the next one, what happened? Then the next one, come to the next one, is after the research and development. Here, a team of foreign lecturers visited Sri Lanka to review the quality of the academic programs. During their stay in Sri Lanka, 2,420,000 was incurred by CBE as food and lodging expenses, and it was recorded under promotion and marketing. Not allowed? Then why we have incurred these expenses on behalf of this foreign staff? They can have their own the accommodations and the lodgings and the food, everything. These are not incurred for the production of income. In terms of the entertainment, this should be disallowed. In terms of the entertainment, this should be disallowed, but with effective from 1st April 2021, this definition, entertainment definition, has changed. It's only for the beverages and the liquor beverages likewise, but for your year of assessment, no change, this should be disallowed. Then here food and lodging expenses disallow, this kind of the entertainment expenses under section 10 subsection 1b Roman 7. That adjustment also considered. Now we will come to the next one. The compensation of rupees 1.8 million was paid to a senior librarian in May 2020 for the forced termination of his service on a non-uniform basis. Tax has not been deducted from this amount. Now they are not a voluntary VRS scheme, this is the forced termination has made to him. The compensation 1.8 million has given, tax has not been deducted, then Puta, since the tax has not deducted on this compensation, then this should be disallowed. Under the section 10 also it has very clearly mentioned this should be disallowed. Compensation disallowed, the not uniformly applicable and relevant income tax rates applicable has not been deducted, therefore it is the 1.8 million should be disallowed. And think like this also, it's a force, that's why examiner has given, it's a forced retirement. Then on the forced retirement, why we are paying a compensation? And finally, it's not incurred for the production of income even. Okay. Then it's the that adjustment done. Next one, bad debt written off include the write-off an irrecoverable lecturer's loan amounting to rupees 8 million. Irrecoverable lecturer's loan. Now, we are in the business of providing of educational services. While in the business of providing of educational services, Lamai, we have given loan to our lecturers. Is it under our principal business activity of providing of educational services? No. This is the other than the business income. What is this? Since it is loan, we are receiving interest income. I am taking this under investment income. Therefore, Lamai, this bad debt write-off of 800,000 can be considered it as a business in the relevant expenditure to generate business income? No. We will see, I think, in the other finance income, interest income from lecture loan, 1.3 million. From this, that 800,000 should be deducted. Then this 800,000 should not be incurred for the production of income of the business, but for the expenditure incurred for the production of income of the investment. Therefore, it should be disallowed in the where the adjustment here. Bad debt written off disallowed and claimed against investment income, since this is relevant to the expense on investment income 800,000, it should be disallowed. And in the same time, I am going to the investment income. This is for investment income, and what I am doing, this 800,000 I have not here as a deduction from the staff loan interest. Okay, then I am not missing anything, any adjustment at the last minute. The next adjustment, 20% of the maintenance and utility charges relates to the letting out of the college premises to private class teachers. Lamai, since it is the effectively connected to the business, it is a business income. Since the expenditure incurred to generate the business income, that also, and what? Allowable deduction. You have to write it. Then for the business income, maintenance and utility charges 20% related to business income. Since the income is effectively connected to the business, no adjustment required. There is no adjustment required since it effectively connected to the business. Done. Then the next one, the promotion and marketing includes rupees 200,000 incurred on advertisements published on the recruit and assistant manager for quality assurance. The staff recruitment advertising, this is an allowable deduction. The 200,000 which included in the promotion and marketing, then it should be allowed. You have to write your explanation here, Lamai. The advertising for staff recruitment, it is incurred for the production of income. It should be an allowable deduction. Next one, CBE has paid rupees 1.6 million during the year of assessment as damages to a contracted electrician for the injuries suffered while working at the building construction site. This amount is included in contractual services. Now you can see, Lamai, in the contractual services here in here contractual services, the 6.7 million is there. It has included the here the 1.6 million damages to a contracted electrician. I have the construction sites of building which for the building which constructed for the educational, the providing of education. What happened? We have hired the contractor during the period of during the period of the construction. That means it's for my work. He has damage. For that damage, I have make a payment of the 1.6 million for that person. It is an allowable deduction. It is an allowable deduction. Come to this one. Payment made to electrician, contractual service, allowable under section 11, Lamai, because it is for the production of income, because we have to incur that he is our contractual, if I have a employee for the construction of the building. Then next one, during the year of assessment, students guidebooks worth rupees 3.6 million were written off from the provision account made for slow moving stock. Now there is a slow moving stock of we have to disallow it. Where is it? The slow moving stock, promotion and market, research and development, bad debts, provision of slow moving stock 1.9 million. This should be disallowed first. We will do it. The provision for slow moving stock, it should be disallowed. Section 10 subsection 1b Roman 8, and that one done. I am again coming to the paper. It has given, however, there is a write-off. During the year of assessment, student guidebooks worth of rupees 3.6 million were written off from the provision account made to the slow moving stock. From the provision account, it has the write-off. Okay, write-off from the provision account, but no detail has provided whether it has separately taken or not, but here the 1.6 million, the provision for slow moving stock 1.9 million, it is charged to the income statement after writing off that one. Therefore, it is the during the year expenditure incurred, we need to write off, we need to allow it as the allowable deduction, take in the provision, disallow, and the write off to allow. Write off of slow moving stock, allowable deduction under section 11, it's a 3.6 because this is the ending balance, Lamai. Then we need to take this amount separately as the allowable deduction of 3.6. Okay, done. Now the next one, next adjustment, CSR expenses comprise the following: Vidu Nimsara, July 2020, a 2-day educational workshop conducted free of charge for the A-level students in the area of rupees 4.2. Anyway, Lamai, it should be disallowed because CSR activity is not incurred for the production of income. Donation of computer required computer equipment to the University Grant Commission UGC in Sri Lanka 1.8 million. What's the adjustment to the CSR activities or rather donation? Entire donation in the income statement you should disallow. And second dilemma you need to look at, is there a qualifying payment which we can deduct under assessable income? Now 4.2 million definite dilemma you should not deduct as the qualifying payment. It is not the donation made to institutionalized care for sick or needy. It is not the approved the donation made to the approved charitable institution which published by the minister of that particular. Then these are not the donation to the particular government and the institutions. The 10 or 11 or 10 number of list has given, not the donation like that 4.2, but 1.8 it's for the donation to government or the donation to the local authority of the government. This is the University Grant Commission in Sri Lanka. Then 1.8 million you have to claim as the deduction from the assessable income under qualifying payment. Entire CSR expenses 6 million you need to disallow. The CSR in the administration expenses, CSR expenses 6 million, first lemma you have to disallow it, 6 million under it is not incurred for the production of income. The section level I cannot quote because it is incurred for the production of income. The only answer which I can tell, it is not the requirements of the section level not satisfied. Then I am coming to directly the taxable income. Here donation to government 5th schedule, the schedule 1B can claim up to the assessable income which is donation to the UGC University Grant Commission. I have taken it before, I am forgetting that. Done. Then next one, what is the next adjustment? CSR done. Then investment income earned from the fund established for a special event was used for organizing a special event for the students of CBE. Why it has given like this? Investment income earned from the fund established for special events was used for organizing special events for the students of CBE. There is other income and interest. There is first finance income, interest income from the special event fund 2.1. For that you need to make a quote whether this is investment income or a business income. Then what it has given, it's your own view. Since it's a interest income, you can go under the investment income and remove it from the business income and take under the investment income, or else you can take, since it is effectively connected to the business, it's the part of the income, likewise you can take. Okay, then it's alternative answers you can go. We will come to that. Here the business income, interest income from special event fund. I have taken it as since the examiner has given all the details, it is effectively connected to the business. No adjustment required under section, no adjustment required since it is effectively connected. It is under section 6 subsection 2G. I have not done any adjustment for this one. If you need, since it is a interest income and you think fit it as the under investment income, you can take with proper justifications. Next one, the actuarial gain recognized during the year in the statement of other comprehensive income relating to the retirement benefit obligation was 48,996. The actuarial gain, then its gain should be added to the gratuity provision, then that adjustment we will take with the gratuity provision. We will do the gratuity adjustment now. There is a retirement benefit obligation, provision for the employee retirement gratuity 520 lamai, this should be disallowed. We will do the easier thing first. Provision for the retirement benefit obligation, it should be disallowed under section 10 subsection 1B Roman 8, it should be disallowed 520. Done. Now we will come to the computation of the gratuity. Computation of the gratuity payment. Now, if I have gone for the pre-scene, here in the financial statements, in the financial position, here the non-current liabilities in that retirement benefit obligation lamai, the opening balance and the closing balance has given. I have taken that figures from the given the pre-scene. 1.3 is the closing balance, 865 is the opening balance. Here we go. Opening balance from the pre-scene 865, 637. Closing balance from the pre-scene 1,345,000. Provision for the year from the unseen 520,000. Actuarial gain, the gain should be added to the gratuity provision here 48,996. What is the amount of gratuity paid after adjusting all lamai? 89,400. 89,400. What is the adjustment for gratuity? We need to allow it in the when arriving into the business income. Done. That one also completed. Now I am again going to the paper. After the actuarial gain adjustment, here the details of the assets acquired during the year 2021 as follows. Building work in progress not eligible for the capital allowances. Land acquired during the year of assessment to expand the business. It is a capital asset of the business, not a depreciable asset of the business, not eligible for the capital allowances. Motor cars, travelling purpose motor vehicles, not eligible for the capital allowances. And please keep in mind with effective from 1st April 2018 onwards, motorcycle also eligible for the capital allowances. Previously it has not defined, now it has defined. Then motor bicycles also eligible for the capital allowances with effect from 1st April 2018 onwards. Then teaching equipment for lecture halls, definitely we can provide capital allowances for the 5 years. Library books and periodicals, yes, we can provide capital allowances. Van for lectures transport, 9-seater with air conditioning, 7 million. It's can assume 9-seater mean 1 lecturer 1 seat. If it is so 9 seat is, this is not eligible for the capital allowances because at least 13 passengers can travel in that vehicle. This is assume that 9-seater means 9 passengers, then this is not eligible. Furniture for student hostels, then it is student hostel. If it is a own hostel, own building and the hostel income we are receiving, then this is a depreciable asset. The 16.4 million we need to provide capital allowances. Then this is first we will provide the capital allowances during the year and we will come to the rest of the adjustment. Here we go, the capital allowances section 16 and the 4 schedule to the Act and Transitional Provisions Gazette notification, because the assets acquired prior to 1st April 2018, we have to provide the depreciation allowances based on the previous act. Additions during the year 2021, building the WIP not eligible for capital allowances, there is nothing. Second, land again not eligible for the capital allowances. Next one, motor car not eligible for the capital allowance, the motor car not a commercial vehicle. Then after that, a teaching equipment for lecture hall, it's a 9,670,000 divided by number of years 5, then we are ended up with the 1,934,000. Library books and periodicals, it is 11,540,000 divided by 5 years, it is 2,308,000. Van for lecture transport, only 9 seats, that is my assumption, only 9 seats, therefore not applicable for capital allowances. not more than 13 passengers as described in the 4th schedule to the Act. It is no capital allowances given. Furniture for student hostel, these are depreciable asset. 16.4 million divided by 5, 3,290. Now, the next one. Rupees 1,650,000 has been paid to the broker involved in the land purchase. There is a land of 1,650,000 which we have purchased. For that there is a brokerage fee of 1,650,000, definitely a 1% on this. But it's 0.1%. Then the thing is, Lamai, this is relevant to the acquisition of the capital asset. Then this is relevant to the capital nature transaction. This should be disallowed. Come to that. Broker fee for land purchase, capital nature. It should be disallowed. It should be disallowed. Done. Then the next one, capital allowances claim for year of assessment 1920 were 64.5 million. None of the assets were fully tax depreciated in year of assessment 1920. Why this none of the assets were fully depreciated? That term has given, Lamai, because for you to understand this opening capital allowances relevant for the asset on opening balance remaining unchanged for this year of assessment of 2021 as same, then the capital allowances on the opening depreciable asset 64,500,000 is the same which we need to provide as the deductible amount. Capital allowances of opening depreciable asset 64,500,000. All these things we have considered. Done. Then the next one in the paper, the following information is provided in respect of the brought forward balances. The ESC brought forward from 1819, ESC brought forward from 1920. Lamai, economic service charge has abolished from it's from 31st December 2019, no more there. Then this we need to ESC paid during the year, no, but ESC carried forward. You need to look at whether this can be claimed or not. Brought forward from 1819, that year we can claim. That carried forward period is 2 years, 1920 and the 2021 for both years. For 2021 we can claim this. What is the amount? 1,410,000 you can claim. The second one is brought forward from 1920. The 1920, it's a paid year, yes. It's a 2021 and 21, 22 up to that you can claim. In obviously in 2021 you can claim. What is the amount? It's a 3,480,000. These two amounts you all can claim. Then I am directly going for the taxable income sheet, tax computation sheet. In that I am taking these two figures as the economic service charge, which is 1,410,000 and the 3,480,000 as the tax credit. Done. The next one, the unclaimed withholding tax credit and all, I am not considering, since with effective from 1st April 2020 withholding tax provisions were abolished. The advance income tax is there anyway. Due to this reason I am not considering this one. Then during the year of assessment 2021, CBE paid 60,185,000 as income tax installment payments. Then this is a tax credit 60,185,000 here. This is a tax credit it has considered. Now every adjustment we have considered. Now I need to take from the first to end what we have to miss. This one, profit before tax, years we have considered, revenue taken, remuneration, academic and non-academic, allowable deduction, royalty we have done the adjustment, training and development done, compensation done, promotion and marketing done, provision for employee retirement gratuity completed, research and development done, bad debt write-off done, contractual payments completed, maintenance and utility charges adjusted, depreciation and amortization 101 million should be disallowed. The depreciation and amortization under section 10 subsection 1b Roman 8, this should be disallowed. Done. And the next one, provision for slow moving stock completed, CSR expenses completed, consultant fee paid on academic appeals, then anyway no the breakup has no detail has given, then this can be assumed as incurred for the production of income. It's a consultancy fee paid on academic appeals, then definitely it's applicable for the production of income. This is an allowable deduction. This is an allowable deduction. Okay, no adjustment required. Then on the other income, income from conducting carnivals and fairs, profit from sale of books and publications, grant received from the district secretariat and the write back of the registration fee, all are relevant to the business income. Come to this one, therefore no adjustments required, all are other income relevant to the business which we are conducting, carnivals and fairs and profit from sale of books relevant to the business, carnivals and fairs for students. Grant received is very clearly given, the district secretariat office for a proposed expansion project, then writing back of registration fee received in advance, all are relevant, then it's other income. And then finance income, interest income from term deposit, interest income from special events, we have considered it as effectively connected to the business. Lecture loan, investment income, unrealized gain we cannot take, realized exchange gains on referral fee received, this is part of the business income. We will come to the adjustment. Here interest income from term deposit, it's part of the investment income. Interest income from lecture loans, part of the investment income. Unrealized gain from unit trust, this is not a realized gain, then we cannot tax it. And realized exchange gain on referral fee, part of the business income. Then all these three we have to consider under investment income. I am going for the investment income and I am coming to here term deposit interest gross amount and the staff loan interest. I have taken, I think there is a mistake in the number. The interest income from term deposit, it should be 54,850, not 84. It is 54 done. It's a 54,850. Then staff loan interest, it's a 1,350,000 minus 800,000, which is bad debt write off on that. Then this is the investment income which we have considered from here. Any adjustment to take? The finance cost is a finance cost, all information I have taken from the pre-scene. Then we will come to the finance cost adjustment after this. Finance cost, computation of the disallowable finance cost. Finance cost as per income statement, overdraft interest is only the one, 7.1 million. Then total finance cost, total borrowings as per pre-scene, I have taken long term and short term loan and bank overdraft, the total amount as per the pre-scene, and we need to look at the stated capital and the reserves. Share capital I have given in even PPT, it's a 625 million. The reserves, if we have gone for this one, here the stated capital is this much. Other than revaluation reserve, retaining earnings is a 1,094,000,000. Definitely it's a higher than our finance cost lamai. Maximum borrowing limit is this much. There is no excess. no disallowable finance cost. Since the actual borrowing limit is below the maximum borrowing limit, there is no disallowable finance cost. That therefore, entire finance cost which incurred for the production of income of the business, the bank overdraft interest under section 12, it should be allowable deduction. It should be allowable deduction. Okay. Now that the particular the other income part, consultation payment made to have academic appeal, it is allowable deduction lamai, no adjustment required. Profit from sale of books and publications, it is effectively connected to business, no adjustment required. Income from conducting carnivals and fairs, it is effectively connected to the business. Grant received from the divisional or district secretariats of it for the purpose of expansion project, part of the business income since received for prospective business. They have obtained a land, all these things done for a future business, this has received for the prospective business. Can you remember in the definition of the business, past, present and prospective business included? Then this is part of the business income, therefore lamai no adjustments required. Written back of the registration fees received in advance, allowable deduction, and this is effectively connected to the business. Written back mean this is coming as the income, therefore this is actually a part of the business income. This is part of the business income. The advance written off, the advance account debit and the other income credit, part of the business income. Done. Then all the adjustment we have completed, gratuity payment done. Now only the calculation part, the minus side and the plus side, and from the minus side we have to take here, and there is a business income of 537,464. Now it should be come to here as the business income, assessable income from business under tax computation. Under investment income, the term deposit considered, staff loan interest considered, then the total assessable income from investment is the total assessable income from investment 55,400,000. Then it's coming to here, then your total assessable income other than other income we don't have from this tree, total assessable income 592,864. Done. Then less qualifying payments, there is a qualifying payments of 1.8 million. After deducting that qualifying payment, we are ended up with the taxable income of 591. Taxable income of 591. Now lamai, the application of the tax rates, application of the different tax rates. What I have done, I have apportioned the business income like this. The apportion, because separate accounts are not there, then I have done the apportionment of the business income and I have applied the income tax rate separately. Then the usual note which I am putting, not other than the specifically mentioned adjustment, all other expenses and income considered as allowable for tax purposes. Then apportionment of the business income, this what we can do. On gain and profit from the providing educational services, we need to take separately. I have taken the assessable income from business with all these businesses is divided by total turnover given in the question 1.2 billion. Given in the question it is 1.2 billion here. From that I have taken the educational services separately. Educational services separately by removing the hostel fee. Then for this one we have taken the answer. On gain and profit from other than providing educational services, which is again accessible income from business divided by total turnover Then turnover relevant to the hostel fee, I have taken it. Then apportionment of the business income for this hostel fee I am receiving separately. Then it is not the providing of educational services. Then total assessable income from business, the same amount 537, but why I have taken like this? For me to apply the tax rates correctly. Come to the application of the tax rate. This is my format of the application of the tax rate. CBE Private Limited and the schedules to tax computation. What is the schedule? The calculation of income tax liability or computation of income tax liability. Assessable income from business level I have divided to two. One is on gains and profit from providing educational services. Gains and profit from providing the educational services. That's the first part. Why it is liable at the tax rate of the 14%. That 526 which I have taken here with the apportionment taken here, and no qualifying payments I am taking to that one because the rate is 14%. I am taking the qualifying payment for the higher rate. Taxable income is same. Then tax liability is the 526, that taxable income at the rate of 14%, 73 million. Now gains and profits from the other than educational services, the hostel fee taken, the business income relevant to hostel fee taken separately. Qualifying payment, even you can apply to this one or interest income, whatever normal under the tax planning what we are doing at the higher rate, the tax, to reduce that higher rate tax we are applying the qualifying payment to that. Then taxable income is same. Since it is not the providing of educational services, for hostel income, since we do not have any other concessionary tax rate, I have applied the normal tax rate of the 24%. Done. Then the providing of on the assessable income from investment, on interest income from term deposit and the lecture loan, this is the assessable income from investment. Here 54,500,000, then I have taken it, and now the qualifying payment 1.8 million I have given here because it's even for this one and this one you can go for that higher rate එකෙන් tax වෙන එකට අපි qualifying payment එක දෙනවා. No, the method to give only is a deduction from the assessable income. In the tax planning perspective, what we are doing, providing the qualifying payment to higher rated tax income, taxable income. Then after deducting qualifying payment, taxable income is 53.6, the applicable rate is 24, then the tax liability is 12,864,000, the total tax liability is 89 million with the different tax rates. Now assessable income 592, any change on this? Nothing, it's 592. On qualifying payment, any change of this? No. Taxable income, any change of this? 591,064, 591,064. No lamai. Everything done. Then this is my taxable on taxable income. This is my tax on taxable income applying of the different tax rates described under schedule 3. This is my income tax liability, and then these are the tax credit. There is a balance tax payable of 24,108,969. Okay. Now this is the end of the discussion of this, the company taxation 30 marks question in the section 2, question 3 part A we have completed. Lamai, please go through, please aware on the changes under the new amendments, and if it is so, and your patries and your the speed of writing and all these things makes to take this 30 marks for your examination. Please practice on these things because this is one of the easy question you can gather the marks. Okay, then I am shifting to my PPT. On the PPT in the section 2 question 3, this 30 marks part we have completed. There is only the 10-20 marks question we have to do. Two 10 marks question we have to do, we will do it. Then with this one I am winding up the discussion of the section 2 question 3 part. Okay, now this is the last discussion of the July 2021 paper. Then in here lamai the two 10 marks questions we are going to discuss, which is all the thing is a writing part of your paper. It's writing part of your paper. Then we need to look at what are the requirements which are from the examiner. This is in the question 3, your pre-scene based question, the last 2 questions under the question 3, which is in the part B, Roman 1 and Roman 2 we are going to discuss, and again the question 3, part C, Roman 1 and Roman 2, totally a writing part of the questions. We will come to the part B, as in the analysis, what it asks in advice on tax implications or benefits of business decision with transfer pricing issues. Now, 2 things testing. One, you need to tell from this business decision which the company CBE has taken. CBE has taken a business decision. On this business decision, what are the tax implications or tax benefits? It's a one requirement. Second one, is there any transfer pricing implications? Okay. Now let me come to the paper and we will look at the requirements of the paper. Okay. Here, this is your paper, and in the question 3, we are in the last part, which is here. Okay. Now, this is a requirement B. Come to the requirement first. Required as per the tax consultant of CBE. Sorry, as the tax consultant of CBE, you are the tax consultant. What it asks in advise the board of directors of the company, clarifying whether you have to advise for the 7 marks by clarifying 2 things. First one is the above proposal can be considered as by the Department of Inland Revenue as tax planning to avoid tax by how lamai splitting the income, assuming that the newly formed company is exempted from income tax for the period of 5 years per provisions of the Inland Revenue Act. There is a proposal. You need to tell from this proposal, as per the view of the Department of Inland Revenue, is there an income splitting arrangement. Then in the bullet 2, the above proposal would give rise to transfer pricing issues. Now, the 2 things for the 7 marks it has tested, you will write the answers for the 2 parts to take the 7 marks. Okay. Now, we will come to the facts of the question. I will first complete the Roman 1 and I will then come to the B. Jagat came up with a new proposal to invest in digital learning platform by forming a separate company with the 50-50 shareholding between Manil and him. Now, what's the proposal? This is the proposal as per the paper. This is the proposal given. Now, you have to evaluate this proposal. No? This is the proposal. What is the proposal? Form a new company. Form a new company by having a shareholding of the 50-50 by Mr. Jagat and Mr. Manilal. Mr. Jagat and Mr. Manilal. Then what is the purpose of this new company? This is for the digital platform for what? That's mean online, the platform to the CBE. What's the purpose, Lamai? Per the proposed arrangement, the newly formed company will have the rights to the platform of CBE. CBE is providing educational services for that platform. The newly formed company is providing, facilitating the platform to the CBE, which for the online education, will pay a service fee. CBE will pay a service fee with high markup to the new company for the usage of the digital learning platform. Now what it happened, this is the proposal. What is the transaction with this proposal, Lamai? The transaction is, with this proposal, there is a now CBE, educational service provider, and there is a newly formed company. By newly formed company is providing this online platform to CBE educational services. Then this newly formed company is exempted from income tax. And here the CBE for this service, CBE is granting a service, then the CBE is paying the fees to this online, to the taking of this service from this newly formed company. What the price for the fees? What is the price? The price charge is the high markup. At the high markup. Now let me analyze this. Now with this proposal, what happened? Now examiner is asking, above proposal, you have to advise, above proposal can be considered by the Department of Inland Revenue. This is a tax planning with the intention of the splitting of the income or not. Then this is the first thing asking. Now Lamai, you have to take the situation where this is exempt from income tax and CBE is a company liable to pay income tax. Liable to pay income tax. Now you need to look at what's the relationship between CBE and newly formed company. Are these companies are associated person? Associated or not? Yes, associated. Why associated? This is for new company, the 2 shareholders, and the CBE, there are 4 shareholders. Among that, 2 shareholders are the shareholders of the newly formed company. Thereby, Lamai, they are associated. How? Individuals or individual controlling both the or having the ownership in the both company. Now it's associated. Now you need to look at if there are associated person, in this associated person they are having arrangement to income splitting. Or there is a tax, the avoidance scheme is there, then here you need to use the provisions of the section 34 and section 35 of the Inland Revenue Act, as well as you can link the section 33 of the Act even. This is the situation. Then you need to tell whether this is a splitting of income or not. Yes, Lamai. By looking at this, we don't know what's the, if this new company has formed for the business, totally a business purpose, without having any intention of the income splitting, then no matter. But if this new company has formed only for the income splitting, there is income splitting arrangement. Why? CBE paying income tax at the rate of 14% plus 24% for their income, and the higher fees is charging to the exempt company, then this is income to this exempt company, but even it has higher markup has charged. Any tax implication, Lamai? No. Why it is exempted? Now for CBE, for what? They are paying fees. It is a direct cost to the CBE. It is direct cost to the CBE, which leads to what? Reduction of the profit, which leads to reduction of the profit. Reduction of profit. Due to this profit reduction, lamai, CBE pay in a lesser amount of tax, less tax. This is the arrangement within the associated person. One person is shifting the revenue to the exempted company. To have this kind of arrangement, in section 34, it has very clearly mentioned the situations where this kind of arrangement should be, in that one company is paying tax and other company is paying a reduced tax rate, so not paying a tax situation match. Clear? Then this is the arrangement. If this new company has formed totally for the intention of the tax avoidance, go for the tax avoidance scheme, then this is as per the view of the Department of Inland Revenue, income is split in by associated person under section 34-35. Clear? Then if not, if this is a business purpose, merely in the business purpose, then no harm, we need to prove that. This is your answer for the 7 marks, one part. Now the part in the Roman 1. Now with this I am taking a Roman 2 also. It asking transfer pricing issues. Lama, it is obvious. See, there is a transfer pricing issue. What is a transfer pricing issue? There are, first thing, when it comes to transfer pricing, you need to recognize whether what is the kind of the transaction. First thing you need to recognize whether there are associated person. No. Is there associated person? Yes. Associated. The newly formed company and CB associated. Do they have transactions in between associated person? Yes. What are the transactions? The domestic transaction. This is the fees paid on the online platform. Domestic transaction. Now, the third question you have to ask, in this domestic transaction, is there charge a price? Yes. Is that arm's length or not? Lamai, no, it is not arm's length. Why? Very clearly examiner has provided it is charging a price at a high markup. The word in high markup means it is not the uncontrolled transaction, it is a controlled transaction. The controlled transaction in between associated person shall be in the arm's length price like uncontrolled transaction with the independent third party. Now there is a transfer pricing issue according to the section 76 and section 77. You have to address by the section 77, which is domestic transfer pricing, and the transfer pricing regulation under the Gazette notification issued. You need to write your answer. Okay. Now explanation given. Now we will come to the answer and the analysis of the question. Then come to the answer. It's for the question 3 part B. Then part B, Roman 1, analysis of the question. There is a proposal given. What's the proposal? Invest in a digital learning platform by forming a separate company. How to form a separate company? By investing in 50% and 50% of shareholding by Mr. Manilal and Mr. Jagat. The same shareholders, the 2 of the shareholders among 4 in the CBE. Why? What need to do? What you have to do? Implication of proposal. Per the proposed arrangement, the newly formed company will have the rights to the platform and CBE will pay a service fee with the high markup to the new company for the usage of the digital learning platform. That's the examiner has given a keyword by taking, as you can see, Lamai, as the high markup. It has given as high markup. Then what's the action verb? Action verb is advise. The tier 5, evaluate. In the tier, what's the meaning of the advice? Offer suggestions about the best course of action. Now here, what is the best course of action? You have to tell the examiner whether this is the income splitting arrangement or not, and whether there are transfer pricing issues or not. That your conclusion and recommendation. Required advice to the board of directors, the coverage of funds, the transfer pricing matter and the income splitting matter both. The 7 marks allocated to for writing of the answer for all these 2 matters. Don't write 1 and expect a marks. Then therefore come to the answer, the allocation of marks 7, time allocation 12.6 minutes, then you have to address these things. This is the detailed answer. First part, advise on whether the above proposal may expose the company to tax avoidance or income splitting issues. Now, I am addressing from the theory starting from the section 34. As per section 34, income splitting is splitting of income between associated person, a reference to the person attempt to split income includes a reference to the arrangement between associated person. This is section 34, subsection 3. In that, what are the 3 situations, Lamai? For the transfer of an asset directly or indirectly, including the transfer of an amount to be derived, it's not applicable to here, where the transfer retains a legal or implicit right to benefit currently or in future from the asset, that also not relevant. Come to see where one of the reasons of the transfer is to lower tax payable by any person. Now here, due to this transfer, my CBE pay in a lower tax rate. Thereby, seems to be there is income splitting arrangement. Now this is theory part which I have taken, and we need to come for the application. When analyzing the transaction, the newly formed company that generates income through holding the right of the platform will be exempt from tax, and while CBE, who pays the service fee pays tax, and CBE pays service fee at a comparatively higher rate. This you should address, Lamai. Then the market rate, that means it is not a uncontrolled price, it is a controlled price, the controlled transaction in between associated person. Higher rate than the market rate in order to split the income between 2 companies. One company paying income tax is splitting the income to another company. What is the form of the another company? Exempted. For this one, if this kind of arrangement is not there, then the CBE has to pay the normal way in the tax, that means higher tax, but due to this arrangement, now CBE pay in a lesser amount of the tax. Accordingly, as per section 34 subsection 1 and 2, where a person attempts to split income with another person, the Commissioner General may prevent any reduction in tax payable by issuing a notice in writing, and a notice referred to in previously may contain amount to be included or deducted in calculating the income of each person. Or C, recharacterize the source. Commissioner General can recharacterize the source and type of income or loss, amount or payment. Why? If there is no such kind of the arrangement, that's the recharacterizing, what is the tax, then Commissioner General can charge. This is the implication. Now further, as per section 35, tax avoidance scheme, where the Commissioner General is satisfied the following characteristics are in the scheme. A, scheme has been entered into or carried out. A person has obtained what, Lamai? Obtain a tax benefit. That's why examiner is asked any tax benefit is there. Tax benefit in connection with scheme, and having regard to the substance of the scheme. එහෙම scheme එකක් තියෙනවා නම්, with the substance of the scheme, it can be concluded that the person or one of the person who entered into or carried out the scheme, what's the purpose? Did so for the sole dominant purpose of enabling the person to refer to have a tax benefit. My sole intention is to have the tax benefit, but here Lamai, we don't know the requirement of the newly formed company. If it is essential in the business purpose, then it's not the sole or dominant purpose of the having the tax benefit. Then next one, the definition of the scheme, is as per the provisions of the Inland Revenue Act. Then therefore, this is a conclusion. In the conclusion, therefore, the above proposal may lead to income splitting or tax avoidance as per the provisions of the Inland Revenue Act if the arrangements have been made, merely to have a tax benefit. If the dominant intention is to have the tax benefit, then it should be the income splitting arrangement, but if the dominant intention is not like that, then it is not. Benefit while the newly formed company exercises the tax exemptions in future. Then this is the conclusion. You have to apply the provisions of the Act by analyzing the question in this manner. Okay, now I am coming to the transfer pricing part. Now, when it comes to the transfer pricing, there is a change of the Gazette notification. Now the 2217, this is the new Gazette notification which was issued on 2nd March 2021, and it is effective from the, it is now previous Gazette notification of the 2104/4 has abolished, and the new Gazette notification with effective from 1st April 2020 has came into effect as the 2217/7, the establishing the transfer pricing regulation. This is operating with effective from 1st April 2020. Then this is applicable on the transfer pricing regulations. Okay. Now with this we will come to the answer, Lamai. Here, as I have explained, first I have quoted from the section 77, the domestic transfer pricing. As per section 77, profit and income or loss from transaction between associated person, it should be having ascertained, having regarded to the arm's length price. Now, further as per section 33, arm's length standards and agreements or arrangements between associate, where the arrangement exists between associated person, the person shall calculate their income and tax payable according to what? According to arm's length standards. Now in our case, it's not under the arm's length standards. Therefore, any transaction in between associated person shall be ascertained having regarded to the arm's length price. Now it has as per section 76 and 77 and the Gazette notification of 2217/7, CBE and the newly formed company are associated persons, since under section 77 subsection 5A of the Inland Revenue Act, it has defined a person shall be an associated enterprise of another enterprise if one person participates directly or indirectly or through one or more intermediaries in the management, control, the capital of the other person. And as per the Gazette notification 2217/7, then what is the definition under the associated person under this scenario? As per Gazette notification number 2217/7, para 8J, where one enterprise is controlled by an individual or jointly by such individual and their relatives, and the other enterprise is controlled by such individual or his relative, or jointly by such individual and his relatives, or jointly by relatives of such individual being an associate. Now see, under that two circumstances, even under the Inland Revenue Act, even under the gazette notification lamai, the two individuals jointly controlling CBE and the newly formed company, then obviously they are associated with this, the direct and indirect control with these two companies with the individual capacity. Okay, not only control lamai, they are owners of the company, and they are having the for new company 50-50 and CBE the shareholding structure 40% and the 10-10 likewise the structure is there. Okay. Then thereby CBE and the newly formed company are associated, and transactions between associated persons shall be in the arm's length price, and the definition of the arm's length price I have taken as per the gazette notification. Then what's the condition? It appears that to an assistant commissioner in the course of his audit, that means what? Transfer pricing audit, that any transactions between associated enterprises had not taken place at arm's length price, then he can continue a arm's length audit. For the ascertain the arm's length price to the transfer pricing audit. Okay. Then as per the regulation, one of the transfer pricing regulations, the transfer pricing regulations apply to the domestic transactions made between associated enterprises as referred in section 77. If there are the three conditions where we should look at in the transfer pricing regulations in the paragraph 1 of the gazette, according to the domestic transactions and the international transactions. In that, if there are the two associated company, one associate company is exempt from income tax, one situation. Second one associated company is charging a lesser tax amount than the lesser tax rate than the other associated person, and my third situation is one associated person incurring a loss. In our case, the one associated company is exempted from income tax and other one is paying tax, then directly exposure to the transfer pricing issue. Come to the answer. Tax exemption granted, any difference between income tax rates, any loss incurred by the associated person. Accordingly, it was noted that the newly formed company that generates income through holding the right of platform will be exempt from income tax, while CBE that pays the service fee at a higher markup, and the high markup is pay taxes. That means the CBE paying taxes, but they are transferring one of the income to associate person. CBE pays service fee at a comparatively high rate than the market rate in order to split the income between two companies. What's the conclusion? Accordingly, as the two companies are associated enterprise and newly formed company becomes entitled to tax exemption, their transfer pricing exposure may arise. Okay. Now, in this manner, you have to write your answer for gathered at 7 marks. Okay. Now, I am coming to the next part of the discussion of the paper, the part B, Roman 2, this one which is talking about for the 3 marks lamai. In September 2020, CBE made a bonus share issue to its existing shareholders for a value of rupees 100 million by capitalizing the profit. This as given. Advise whether there is any tax exposure to CBE under the provisions of the Inland Revenue Act. What it asking, the tax exposure to the CBE, the company, for issuing bonus shares to the existing shareholders. As per given in the preceding lamai, there are 4 shareholders in the CBE. Then for them, they are issuing shares, issuing of shares, or it's given as the bonus share issue, bonus share issue, issuing of bonus shares to whom? To its existing shareholders. Existing shareholders. What it asking? It is asking the tax exposure to CBE, the company. CBE whom? The share issuer. Now, when looking at the tax implication of the share issue, lamai, the bonus share issue, the examiner very clearly provided one word in which is capitalizing the profit. The looking at this one, bonus share, anyway bonus shares are issuing by capitalizing the profit. Capitalizing the profit. Under this situation, how to quantify the tax implication? By looking at this wording, what you need to identify to tax implication on the bonus share, you need to go for the definition of the dividend. Definition of the dividend. Definition of dividend. All the dividends, all the things in the syllabus are essential for your examination. Definition of dividend under section 195. In the dividend definition, it has very clearly provided the one way of the distributing of dividend is the capitalizing of the profit to the shareholders. Then it is asking the dividend, if the CBE has the issue the bonus shares, it's a way of the dividend. What is the tax implication on the dividend? This one, to answer, to get these 3 marks, you should have to identify capitalizing of the profit is the one way of the distributing of dividend. If you have not identified this, the getting 3 marks is not possible. Then we need to analyze the tax implication on dividend. The first thing, there is no tax implication. No tax implication to CBE. Why no tax implication? CBE is the dividend distributor. For distributor of the dividend, person who is distributing dividend, this resident company does not has any tax implication. Why? With effective from 1st January 2020, the WST has abolished on the dividend, has abolished. The earlier, that means prior to 1st January 2020, there was a dividend tax of the, or a withholding tax of the 14% on the dividend. Now it is not there. Therefore, the person, resident company who is distributing dividend is not chargeable with any income tax, but the recipient tax exposure is coming on the recipient, recipients. The recipients, the 4 individual shareholders, 4 individual shareholders. For these 4 individual shareholders, they are chargeable with the income tax on their the slabs. What are the tax slabs applicable to that individuals? On first 3 million 6%, next 3 million 12%, and the balance at the 18%, whatever the rate that it is applicable for individual shareholders, they have to pay tax. Then second one, I am taking, not considering the CBE, but I am considering the normal provision. Recipient is individuals, or the recipient is the resident company. Recipient is a resident company. For this resident company has to pay tax on the dividend income at the rate of 14%. Has to pay dividend, the tax on dividend at the rate of 14%. But these 2 is applicable if the dividend has distributed, if the dividend has distributed out of profit, distributed out of profit, out of profit, then if it is distributed out of dividend received to this resident company, then it is exempted. If it is distributed out of dividend income, out of this is liable dividend, and here out of dividend income as defined in the Act, dividend income, then this is exempted. This is the current provision I have taken into consideration. In the question it has given capitalized in the profit, then obviously Lamai, this dividend has declared based on the profit, then therefore it is liable for 4 individuals at their slabs, and for the resident, if it is a resident company, for my instance I have taken, not relevant for the answer, but if it is a resident company, then on the dividend income, that particular recipient company has to pay 14% on that dividend income, subject to exemptions mentioned in the 3rd schedule of the Act. Okay, this is the answer for the 3 marks. Besides the given requirement, I have analyzed the current position, therefore I am providing a different answer. Then come to the answer here. Question 3, B Roman 2, the action verb is advise, then you have to advise by offer suggestions about the best course of action. Then the coverage of the answer is advice on tax exposure to CBE. On the bonus share issue, you should quote from the definition of the dividends and the tax implication of the dividends. The 3 marks, time is 5.4 minutes. This is the detailed answer. Now first I have taken the definition of the dividend as per the section 195 of the Inland Revenue Act. This is the definition. In that, means a payment derived by a member from a company, whether received as a division of profit in the course of the liquidation or reconstruction, in a reduction of capital or share buyback or otherwise, includes the capitalization of the profit. Examiner very clearly provided they are issuing a bonus shares by capitalizing the profit, then this definition you should need to apply. I am not going to read the entire thing. Then I am coming to my conclusion. Accordingly, capitalization of profit through a bonus share issue considered as the dividend. You should write this. However, as per the Inland Revenue Amended Act number 10 of 2021, WST has been removed with effect from 1st January 2020. Therefore, no tax implication on dividend distribution on CBE. Distribute karana company no implication. However, the shareholders of CBE, Mr. Manilal de Soisa, Lalit Kiriyalla, Jagat de Soisa, Lakshmi de Soisa have to pay income tax under progressive tax rates as per the 1st schedule, para 1, sub-para 1A, since the dividend distributed out of profit, no exemption, but I have given, explained the rest of the part also. Okay. Then Lamai, this is the end of the discussion of question 3, B Roman 1 and B Roman 2. Now we need to come for the next part, one of the very easy question, not taking much time. Then here question 3 part C, Roman 1 and Roman 2 will come, okay, for the 10 marks. Now see here, this is asking if I have gone for the requirement here, discuss whether view taken by the Assistant Commissioner is correct and the validity of the raise in the assessment, referring to the provisions of the Inland Revenue Act and the provisions of the VAT Act. Now, 2 things asking. One is the decision taken by the Assistant Commissioner is correct or wrong. Second one asking the validity of the assessment. 2 things asking, reference to 2 Act, Inland Revenue Act and the VAT Act. Now, you have to recognize these things. Lamai, 7 marks you have to address to the 4 sub requirements. Now I am first going for the 7 marks part, then I will come to the Roman 2. Let me read the question. in relation to the income tax return and VAT returns filed by CBE for year of assessment 18-19, the Assistant Commissioner has issued an intimation letters in August 2020 rejecting the returns filed by the following reasons. Now, this is not relevant for the 2021 lamai. This has relevant for the return which have already filed on for 18-19. Yes, 18-19. Then what is the due date for the filing of the return? The self-assessment income tax return for the 18-19 lamai, it is on or before the 30th November 2019. Now, question 3 part B, part C, Roman 1. Now, it happened for the year of assessment 2018-2019. For this year of assessment, the Assistant Commissioner has sent intimation letters. Intimation letters. What is the meaning of intimation letters? It is reasons for the assessment. Reasons for the assessment. Before the assessment, the Assistant Commissioner has sent the reason for the assessment. Reason for the assessment. Now, first thing is rejecting the return by rejecting the return file. Rejecting the, I am taking income tax part, self-assessment tax return file. Tax return and the VAT return file, both the VAT return, I will take it here, self-assessment tax return file. This is the first situation. Done. Then it's sent on August 2020 rejecting the return file for the following reason. Income tax issue with the deductibility of expenses. Then before this, this is there and I need to come for the answer. You have to write the answer by addressing two things, lamai. First one is as per the provisions of the Inland Revenue Act, provisions of IR Act, as per the provisions of the VAT Act. You have to tell on two things. The first one is whether the view of the Assistant Commissioner, the view of the Assistant Commissioner is correct or wrong, and the time bar provision. Time bar provision. And in the VAT Act also the same thing. View of the Assistant Commissioner is correct. View correct or not, the Assistant Commissioner, and the time bar provision. Time bar provision. These are the requirements. Okay. Then first thing, capital expenditure incurred on the computer faculty building expansion project 625 million. It has incurred on 18-19. Is still in the progress and proposed to the complete in year of assessment 21-22. What are the two bullets point given? Capital expenditure incurred on the computer faculty building has been claimed as what? Investment incentives under the second schedule to the Inland Revenue Act number 24 of 2017. Income tax return file was filed on time. Now, this income tax return was filed on time. We will assume that it's on or before, or we will take it as a last date. It's 30th November 2019, the return has filed. What they have done, let me analyze the situation. They have, first thing is under the second schedule, which is investment incentives, they have claimed the capital, enhanced capital allowances. In that lamai, what are the requirements to claim enhanced capital allowances under second schedule? First one, it should not be for the expansion of the existing business. Now what happened? this is a capital expenditure incurred on the computer faculty building expansion project. What my business? In the education, providing of educational services. What is the reason of having a computer faculty? To expand the educational services. Then is it for the new undertaking or expansion of the existing business? Expansion of the existing business. Now second schedule, one requirement, it should not be incurred for the expansion of the existing business. However, CBE has incurred for the expansion of the existing business. Expansion of the existing business, then it's not eligible. And the secondly, in the second schedule, for that asset, what kind of the asset you have to do this investment? Not exceeding that the US dollar, that 3 million exceeding that amount, in which you have to do? It's in the depreciable asset. Now what is this? This is the work in progress. It's given, is still the progress, is still in the progress and proposed to be completed in year of assessment 21-22. Then this is this the investment should be made in a depreciable asset? Investment should be made in depreciable asset. Depreciable asset. Is this on depreciable asset, Lamai? No. The CBE has incurred expenditure on work in progress. What is the definition of the depreciable asset? Depreciable asset should be owned and used asset which is used for the production of income of business. Is this computer faculty has used for the production of income? No. Then under these two requirements, definitely CBE cannot apply the second schedule. Cannot apply. Then Lamai, therefore is that first part, whether the view of the assistant commissioner is correct? Yes. The rejecting of return is yes. Second one, I am coming, time bar provision. Lamai, what is the time bar provision under section 135, which is amended or additional assessment under section 135? What is the period of time bar provision? It is 30 months. 30 months from the date of return filed. From the date of return filed. The time bar provision. Now see, the company has filed the return on 30th November. Then time bar provision is, it is 30 months mean 2.5 years. Then 2 years comes to 21. Then the last date of the assessment is 31st May 20. It's 30th November to 2019, 2021 year, 2021 1 year, 30th November 2021, then December, January, February, March, April, May, it's 31st May 2022 is the last date for the assessment. Now it is with the, now intimation letter has sent on the August 2020. Now the assistant commissioner is within the time bar provision of the to send the assessment on the self assessment. Then the due date, last date is 31st May 2022, thereby time bar provision is there. The assistant commissioner can raise the assessment. First part I have explained. Now come to the VAT part. Incorrect identification of taxable and exempt supplies. CBE has filed the VAT returns declaring the entire revenue as exempt supplies while claiming the input tax. All the VAT returns were filed in May 2020 by the newly appointed finance manager. Income sources declared in year of assessment 18-19 are very much similar to those in year of assessment 2021. Now we are in the year of assessment 2021. We don't have the information of 1819. That's why it has given same income sources continue. Then what are the income sources? I'm coming to the VAT thing. What are the income sources? Educational income is there. Letting of premises income is there. Letting of premises, and again you all having the referral fee. Now these are the income. Providing of educational services, this is exempted, while these are liable. Then what the company has done? The taken all the income as the exempt income and claim the input VAT, which is incorrect. Only exempt is educational services. Only expenditure which supported by the particular the invoices and all the the expenses relevant to educational income is only you can take as the exempt, and claiming of the input VAT when with reference to the exempted supplies, it should be disallowed, and the balance the input VAT under section 22 of the VAT Act, section 22 subsection 6, you have to claim the input VAT based on the requirements, and in the input VAT relevant to exempt supply you cannot claim what, but what is the company has done? Has declared in the entire revenue as exempt supply, incorrect. Supplies while claiming the exempt supplies while claiming the all input tax, incorrect. Thereby the assistant commissioner view to send the assessment is correct. Here also assistant commissioner is correct. Time bar provision. What is the time bar provision for the VAT Act? Namai under section 33 of the Act, VAT Act, time bar provision is 3 years. 3 years from the taxable period which return has filed. Taxable period if the return has filed on the due date. If the VAT return has filed on or before the due date. If the VAT return has filed on or before the due date. On or before the due date. What's the before the due date? What's the due date for the filing of the VAT return, Lamai? It's a last date on or before the end of the next month, ending the taxable period, you have to file the VAT return. Now what happened? The time bar provision to apply the return has, all the returns has filed on 20th, it's given May 2020. May 2020. Now even the VAT returns relevant to 2018-19 period has filed on May 2020. Then Lamai, other company has filed the return on or before the due date to apply the correct time bar provision? No. Thereby this company in the time bar provision not applicable at all. Not applicable at all. This is the answer for the 7 marks question. Now it has given assessment has not been raised by yet for the year of assessment 18-19. The assistant commissioner is free to raise the assessments and VAT for the relevant taxable period. For both, assistant commissioner can raise the assessment for both view of the assistant commissioner is correct. Okay. Now this is the analysis of the question, and let me come for the key points of the answer, Lamai. This is question 3, part C, Roman 1. Action verb is discussed. You have to discuss now, you have to give arguments. What the argument? Whether assistant commissioner view correct or wrong. If this is wrong, why? If it is correct, why? Now this is the analysis. Then coverage of the answer. This is provision of the Inland Revenue VAT, VAT Act. The 4 things you have to cover. 7 marks given this 1, 2, 3, 4 sub requirements. Okay. Then 12.6 minutes you can take. Here Lamai, the income tax application of second schedule to the Inland Revenue Act, investment incentives. Then I am not taking the theoretical part, but actually I need to come for the application. Accordingly, in order to claim the enhanced capital allowances under the second schedule, the following conditions should satisfy. Investment has to be made other than on the expansion of the existing business. Expense has to be incurred on depreciable asset. I am quoting from this. Accordingly, the company is not entitled to claim enhanced capital allowance on the building as it is an expansion of the existing business and it is not the depreciable asset. Therefore, further depreciable asset means the asset to extent to which is employed in the production of income from business and which likely to lose value because of wear and tear, obsolescence or the passing of time. Therefore, as the building is still under this application construction, it cannot be considered as a depreciable asset in order to claim the enhanced capital allowances. Therefore, Assistant Commissioner's view is correct and the company is not entitled to claim capital allowances, and the time bar provision I have explained it. Therefore, I am not coming to the detailed answer. Value added tax also, the claiming of the input VAT against the exempted supplies and the liable supplies, then you need to please refer to the solutions given. You should refer and go for the lengthy formatted answer. Okay. Now actually I need to come for the part C. My part C, it is totally from the statutory provisions, the 3 marks tested. Then what I really need to tell in the statutory provisions, it's a your exam is open book referential, then you all can go and refer these things at the examination. Then you don't you cannot avoid anything within the syllabus. For 3 marks, it has tested the section 190 and section 185 provisions, which is on the penal provisions applicable, not compiled with the requirements by the Commissioner General, and secondly not providing the information. Quickly come for this one. For the 3 marks, it's a 2 statutory provisions were tested. The outline the tax implication to CBE as a result of the above, referring to the provisions of the Inland Revenue Act. Outline what? Tax implication. Tax implication mean tax, what are the penal provisions under not compiled with these regulations. Come to this. Upon the instructions of the directors of CBE, directors has given the instructions, the current finance manager is attempting not to comply with the request made by the Assistant Commissioner by delaying the submission of the requested supporting documents and not attending to the interview. Now, 2 things telling. One is as per the request of the directors, the delay in submission of the requested supporting documents is a one thing. Second thing is not attempted to the interviews called by the Assistant Commissioner. Then what are the legal or penal provisions applicable, including the imprisonment? We will come to this. I have taken the from the Act and application. As per section 190, impending tax administration of the Inland Revenue Act, if the taxpayer has not obliged to the tax administration provisions, a person who willfully impedes, in our case also it's willfully, intentionally is doing, or attempt to impede the department in the administration of this act shall be guilty of an offence and shall be liable on conviction a fine not exceeding 1 million rupees or imprisonment for the term not exceeding 1 year or both such fine and imprisonment. This is the tax implication. Then for the purpose of this section, a person impedes the administration of this act if person fails to comply with the lawful request by the tax official to examine documents, records or data. We have done it. The request things we have not provided. B, fails to comply with the lawful request by a tax official to have the person appear before the interview, they are not going. Accordingly, CBE would liable for, as per section 190, if the CGIR is satisfied that the company willfully impends the lawful request made by the tax officer and shall be guilty of an offence and conviction of the fine not exceeding 1 million rupees or imprisonment for exceeding the 1 year period. Now, this is the provisions of the section 190. If you know this, it's only you have to write this at the examination. Take the maximum advantage of the open book referential. Now, next part, further in terms of section 185, failure to comply with the notice to give information. If we are not coming for the interview, we have to tell it. If we are delaying with the submission of the documents, we have to tell it. A person who fails to comply with the request for the information properly made under this act within the specified time shall be liable for a penalty of amount not exceeding 1 million rupees. This is the tax implication. Before assessing a penalty, the Commissioner General shall issue a notice of warning and no penalty shall be due under this section where the taxpayer complies with the warning notice within 30 days of service of the notice. To avoid that penalty tax implication, there is a 30 days period also given. Now, this is the tax implications on the impending tax administration and the not providing the failure to comply with the notice by the Commissioner General. Okay, Lamai, then this is the last discussion, that part C Roman 2. With this, the entire paper discussion I have completed in the July 2021 paper. Then please take the advantage of this and take this for the good way for your examination. Then if I have came to the analysis here, the first part we have completed non-resident taxation and international taxation plus the income tax provisions under case law with application to the section 11. The second part, value added tax plus the value added tax and the which again the question 2 is in the case law provision, question 1 with the taxation and business decision making, which is on the tested on the individual taxation. Second question, VAT calculation and the case law provisions with the relating to the section 11 and the testing of the 2 gazette notification with calculation done. And finally, the pre-seen based question in your question 3, the comprehensive income tax computation and the business, the transfer pricing issues and the tax income split in part we have looked into, and finally income tax statutory provisions and the VAT statutory provisions we have looked into in a different manner. And I am again telling Lamai, for the exam take the maximum benefit of your reading time of the 15 minutes and analyze the question carefully, analyze the sub questions like this we have done, write all the answers for the sub requirements, address the action verbs. The examiner is given the action verb with the reason, then you have to write the answer to the action verbs very clearly. You all having the list of action verbs. Don't miss the question in the non-resident and international taxation. Attempt to all the questions in the paper. This is a compulsory, all the questions compulsorily you have to answer. Take the maximum benefit out of the open book referential material and manage your time within 3 hours and the reading time of the 15 minutes. Try to complete the paper, the 100%, at least 95-98% of the paper, then you all can achieve the pass mark. Okay, then all these things I am winding up the discussion of the paper discussion of July 2021 paper, and wish all the very best for your examination. Thank you.